Good afternoon, good morning, good evening, ladies and gentlemen, wherever you may be. It's great to have you here for another Admirals Trading Spotlight webinar with a little bit of a twist here, ladies and gentlemen. Today we're going to be having a little bit of a look at market outlook for 2022. And I am joined by my esteemed colleagues and guests, Marcus and Jens. Good afternoon, gentlemen.
Hello, Paul. Nice to be here, and thanks for having us. I think it will be an awesome session together.
Excellent, Jens. Excellent.
Can you see me, by the way? Can you
Sorry?
see me? Can you see me?
I can. I can see all of you. I can see all of you. I hope that I hope you can see and hear me. So for those of you joining us today, it's as I said, it's a great session. I appreciate that. Always we have a rather global audience. So from wherever you're joining us in the world, you are indeed very welcome. And I also recognize that we have a wide range of experience who join us for our sessions, from complete beginners to people who've been experienced traders. You are all very welcome, and you're all very welcome to interact and pose your own views. We're going to be talking about a few elements or a few particular instruments or areas that are of interest to ourselves. And from that, as I said, if there's something you particularly want to have a look at, or you'd be interested for us to take a look at, if there is time at the end, we'll be very happy to do that. If you're joining us here later, okay, if you're watching this on demand later on the Admirals YouTube channel, it's fabulous to have you here. Be sure to subscribe to the session, give us a like if you found this useful. If you've got thoughts about what the three of us are going to talk about, we'd be very welcome to hear them. Or if you have even considerations, that things you'd like us to see talk about in future subjects, you'd be very welcome to put them in. You're here all very, very welcome. So I'm just going to do a quick intro, and then we'll move across to the slides, and then we will take it from there. So hopefully, if I should be able to share my screen, here we go. If my wonderful assistant, Nathia, can do that, we can enable the screen share, and we can basically get on with looking at some of the slides for this afternoon. Hopefully that's there now. Here we go, as always. Fabulous. Just bring that up there. Excellent. So, as I said, I hope you can hear me. I hope you can see me and my colleagues. I hope you can see the slides. As I said, today we're going to talk about markets outlook for 2022. Plenty for us to talk about. Okay, we could talk about this all afternoon. Sadly, we don't have all afternoon. We've just got our 40-odd minutes, but I'm sure we will pack an awful lot in. Remember, here, Admirals, okay, a Forex and CFD broker, all right, we have a global presence with local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing the opportunity to engage with markets using both the MT4 and MT5 platform. If you have any questions, by all means, get in touch with your account representative and they'll be very happy to help guide you. And if you want more timely content than the webinars, then you can, of course, subscribe to Admirals Telegram there, as you can see it there, Admirals. And what you'll see is that the Admirals team will invariably always be posting sort of more, let's say, timely content throughout the day, which might help you with your own trading endeavors. And what we're going to talk about today, well, as we kind of sort of touched upon, we'll talk about what do the markets hold in store for 2022. It's been a rather eventful start already, I'd say, to markets. So there's plenty for us to have a talk about. We'll have a bit of a discussion about what the kind of best opportunities might be there for us. And, we can have a little chat about what kind of trading strategies we think will work best, what we sort of kind of look to work out. We're all very different in the way we engage with markets, and that makes for, well, A, that's what makes a market, and B, that's what makes for an interesting conversation. For those of you joining us for the first time who don't know me, my name's Paul. I've traded for many years, traded for hedge funds, for high net worth clients. My kind of focus tends to be on FX indices and commodities. And for longer term trading, I tend to be a trend trader. And for shorter term intraday trade, I tend to be a reversal and mean reversion trader. The other guys, as I said, they operate differently. And I said, that's what will make for an interesting conversation for us over the next couple of minutes. So let's cut to the chase, shall we, as always, and talk about and think about the market's outlook for 2022. As the slide says, 2020 and 2021, they were both a bit of a wild year, okay, in terms of life and markets. We've all experienced changes to the way we're living our lives and the way we're engaging with markets. That means there are always lessons to be learned for all of us. And by reflecting upon them, we're in a better position to advance as a trader. As traders, and I'm sure my colleagues would back me up on that, there is always something for us to learn as a trader. That journey is never ending, okay? There's always something to be able to reflect upon, to take on board, and to utilize yourself to help develop you and evolve you to your next level as a trader. But for today, what we're going to look at is, as I'm joined by Jens and Marcus, we're going to have a little chat about markets in 2022, in particular, probably Q1, because we've got the sort of next 12 to 16 weeks ahead of us that will provide, I suspect, plenty of opportunities, and we'll talk about where those opportunities may lie. So, gentlemen, I put together to start just a little bit of a slide there on what I believe are themes of interest for us in Q1 of 2022. So what I'm interested in and what we'll touch upon is effectively commodities and the energy sector. Of course, how that is influenced by what we see going on in Russia and Ukraine at the moment. Big story is, of course, rising interest rates in terms of, how are they affecting the US economy, and in particular as traders, how are they affecting the US indices, and also what impact may they have on Europe and Japan, etc., as we go deeper into the year. And although I've titled that Global COVID Response, what I'm talking about really is that we're getting into a little bit of almost like a two-tier sort of global economy, in that there are certain nations which are coming out the other side of lockdowns and restrictions, where others like Japan and Brazil are actually having, still struggling with that. And what impact is that going to have on global markets and economies? And that we'll see how that plays out in some of the instruments we talk about. So, gentlemen, is there anything there that you think I have missed, or are there any other major themes you think we should be considering for the next few months of 2022?
Yeah, it snows.
Snows.
Which is very odd.
I have in fact a question. So I know a little about your overall approach to the markets, and I have to admit that personally, I am not really deep into the Russia-Ukraine topic right now, and how this could potentially trigger further, especially volatility in oil markets. And what are your thoughts on this? So how could the things develop there? I mean, everyone can see that there's somehow tensions building. Not really. I have to admit right now, these tensions have been around. If I have to say, I think last 7-10 years, something like that. And so to me, in the current environment, it somehow seems like some kind of, let's call it gaslighting or so, that you see what I mean. So to say, well, we just recently saw, I think, a bullish breakout in oil, and I'd really love to hear your thoughts on this. So if we continue to go, to put it simply, I think oil will be really hot, but I wonder if you agree with me that we will reach 100, probably even above that level, and putting further on inflation pressures, which we can currently see in all markets.
Fabulous, Jens. It's almost as if you were set up to ask me the right question based upon what my first slide is. So thank you, Jens.
and by the way, I didn't know that.
I know you didn't. The check is in the post, Jens. You'll be absolutely fine. That's grand. So no, that's a great comment. And actually, my first slide, we're going to touch upon that, and we can build that conversation out into a conversation about energy markets and look at that. So we will definitely cover that, because actually, in many ways, Marcus does have a point, because it's snowing. That in itself will have an influence as well. So just quickly before we move on, listen, thank you for everyone in the chat comments, Tina, Hartmut, Yev, Brun, Carol, Bando. Okay, thank you. You're all very, very welcome here. I hope I pronounced your names correctly there. If I haven't, it's all on me. But you're all great to hear. You'll also see that my wonderful assistant has put a link there to the Admirals Telegram Global if you wish to join on that. So without further ado, let's have a little look at a chart. We're going to look at a few charts, just a few things that are of interest, and then with time, what we'll do is we'll switch across to the live markets and have a little look at those and see how see what we can find of interest in there. So So here's my first chart, okay? This is Paul's choice. This is a monthly chart of the US dollar against the Russian ruble here, okay? So normally I like to work off weekly charts, okay, as my kind of, let's say, my sort of main chart, but I thought the monthly chart here helps us reflect upon, you know, on the kind of the past story. As Jens correctly said, you know, there are tensions there between Russia and Ukraine. And they have really been there for about 7, 8, 10 years. Some might even say further afield. I wouldn't claim to be a historical expert on that part of the world. Basically, I'm just a trader looking at what I can see here. The reason I'm of interest is, yes, there are those tensions there. Those tensions will spill out into energy markets and also just risk sentiment. Okay, markets hate uncertainty because markets are still a reflection of human psychology. Humans hate uncertainty. And so when people are wondering, you know, won't there be any kind of conflict in that part of the world, which invariably has, you know, has huge access to commodities. You know, you've got wheat baskets, you've got oil, gas, Kazakhstan, a few of the other nations around there. It can have an impact. And as I said, markets hate uncertainty. And that is one of the things we have seen. And certainly if you're looking at some of those energy markets. But in terms of US dollar ruble, what I'm looking at here, let me just bring up my old drawing tool here, okay, is that, you know, for this, as I said, it's a monthly chart. What we saw was effectively we had a little bit of a kind of a low there around about 70, all right, there just towards the end of last year. And then what we have seen since then is kind of a rise in there, okay? And if you look at that on the weekly or the daily charts, you'll be able to see that. We have broken that sort of trend line and we head our way towards 80. Now, why is that of interest? Why is that relevant? Because what we will see is that, you know, and Mr. Biden, you know, when he can work out what day of the week it is, you know, he has talked about that, you know, should there be any particular issues in that part of the world, what we will see is we'll see deeper economic sanctions against Mr. Putin and against the country of Russia. That will undoubtedly have an impact upon the Russian ruble. And what we will see is, what we can see over the last few years is that every time we've got up towards about 79, 80, that invariably that has effectively been a resistance level. The reason I had this in as a monthly chart is back here in sort of 2014, when I had to do an analysis on what was likely to happen in, you know, I had to make a call for the year at the start of the year. That was where we saw the issues with Ukraine, where invariably there was a civil war in Ukraine, and invariably the Russians went in and took Crimea. And I was said that a buy on dollar ruble at the start of the year was probably a good trade. It was trading around about 34 rubles to the dollar. And you can see as that sort of, you know, descended into civil war and the issues there, we saw price rally very, very strongly up there towards that sort of late 70s, 80 mark. And so what you'd have to look at is, you know, if we get similar sort of issues there in that area, is that going to have a huge impact on basically people buying the dollar and also shifting towards the shifting out of Russian ruble, in which case a break above 80 and hold above that is, you know, would be a very bullish, I believe, mark for actually an extended further move towards, you know, in terms of dollar strength and Russian ruble weakness. Would you chaps have any particular thoughts on that? Any particular views on what you can see there on the charts?
I'm 100% with you, but the interesting thing is, I have to admit that I'm kind of a fan of the Russian ruble due to its due to the policy approach in Russia, or in regards to the Russian central bank. If I'm not mistaken, they build huge reserves of physical gold, if I'm not mistaken. So and so given that, I think the Russian ruble is nearly 100%, I think, underlined, is it the right wording?
Yep,
underlined with gold, if I'm not mistaken. So given that, and seeing the potential loss of control of the Fed, I don't really like the US dollar, to be honest. And I'd be really surprised, by the way, to see this break higher, based on this opinion. But this is just an opinion, as we already stated, right? So the charts tell you what's going on here, and it's higher highs, higher lows. I mean, we could also say it's a very big a wedge forming, a triangle here, totally. ascending triangle. So I think the breakout potential, well, could easily bring us at 120 or something like that. So I think projected target could be strong breakout, which I'd agree.
Yeah, I'd agree with that, and you're absolutely right. In terms of the Russian central bank, I think if you were to look at MISEX, the Russian index, okay, that has been coming off, right? That's been coming off its high since sort of November time, as well as we're seeing effectively these moves here. I think it's just basically people. I agree with you in terms of who is the more viable operation as opposed to the Fed, as opposed to the Russian central bank. You could discuss that till the cows come home. I think more of it is about risk sentiment, and that doesn't really matter how much gold you've got in the bank when people are sort of capital is a coward, and it will run and hide at the first sign of trouble. And I think if there is trouble in that part of the world, capital will run away from it. That would be my particular view. So there you go. Anything to add on that, Marcus, or we'll move on?
Oh, it's a great chart. I can see a lot of interesting opportunities in the past, by the way, as you mentioned, 2013, or maybe even 2011, 2012, the market was rallying, and we have a lovely trend I can see there. And always September 2012, September 2013, we see correction. And as an investor, there were great chances to make, to buy, to go long in this case. And if you draw the trend properly, then you are still in this. And there's a great opportunity. And even in 2017, September 2019, always there was a lovely trend and always in a correction. And you could be a part of this big moves to the upper side when you open your trade in the correction. And it's always the same. It's always the same. The biggest traders around the world, even in the 60s, back in the 60s, were trend following systems. And it's still the same, because buying cheap and selling expensive. And I don't analyze, I don't interpret, because I'm a private trader. And I figured out in the order book, there is no row where you can type in why you go long or short. So therefore, for me, it makes no sense to interpret something else like central banks, something like this. Is just a private and personal analysis. So in my opinion, I can see lovely, awesome trend and plenty of entry chances. But for me, actually, it's a little bit too late to go long. So it's a kind of high price, but basically maybe they can follow the breakout, as Jens mentioned. But this is a lovely, great chart and another proof how successful trading could be if you follow the trend.
Cool, excellent. Thanks for that. Thanks for that, Marcus. So let's move on to our next slide, which is which is actually one of Jens' choices. So Jens, here you go on gold. So take it away. What do you want to talk about gold for us?
Short.
I have to admit that I think in the morning we received a quite strong signal. Right now, we still have to take a little hurdle out of some wood out of the way. But I think then the doors open up to 1,870, 8,900, or something like that. I think it's very interesting. I think this could be really right now, or next week with the Fed, this could be kind of a clear signal. We could get a clear signal in which direction, in fact, the whole year could bring us here. I was, to be honest, so based on the squeeze higher in 2020 with new all-time highs and the push above 2,000 USD per ounce, I was kind of surprised to see this subdued price action all the time. So I was really surprised also about the bearishness in the mining sector, because there were loads of money being brought to the market, especially from the Fed. I think we now are headed to or already above 9 trillion USD when it comes to the balance sheet. And given all that and low yields, real yields, really, where I think the main interesting part when it comes to gold trading and the inverse correlation to real yields comes into play. Given all that, I was really surprised to see this bearishness, respectively, this neutral behavior. So probably was because many traders were starting to focus on the crypto environment. I don't really know, but what I have to say is that now with the break above 1,830, so this is this dotted line, I think this is a first clear indication that now we are headed to higher prices from there. And we got a sign in the morning, by the way. So in fact, I re-entered the trade. So I was in already on, let me just, today is Friday. I think it was on Wednesday when we saw the first break above 1,800. Yeah, that was in the morning when I was in Marcus' show, by the way. So that was when I mentioned that. And the break happened in the afternoon then, and I had the buy
I
stop
told
there.
you. I told you.
Yeah, I remember. Yeah, I think I took the other side of the trade. I went long while you shorted that. So, yeah, and then the breakout happened, and I was very confident that we probably get to see a follow through because we could hold the breakout. I was a little skeptical because yields were running quite high already. And I thought that there will be probably some kind of a rollover. So I think 10-year US yields topped against 1.9% or so. And then I was like, is this really the big deal, the real deal, this breakout? Or is it probably just a fake out? And then the real fundamental catalyst will be found next week with the Fed. And that's why I was a little skeptical. And then these things turned a little sour yesterday, especially when it came to US equity markets. Not really sure what happened there. Probably was because options are expiring today, and that was kind of a hedging whatever, I don't know, in the S&P. And what I really didn't like at all was that we didn't break higher in gold here and didn't follow through. Because if this is a true risk-off market environment, or we're anticipating a dovish Fed and/or I think we need to see further strength in gold, and that this didn't happen left me a little curious if this is a real deal. And that's being said, when we retested the breakout region in the morning, I was taking out the trade at break even, so around the level where I initially entered on Wednesday, and I was saying, well, the reason for that was, by the way, that in the past I observed that after these breakouts happened, there was sometimes not just a retest of the breakout region, but that you saw a really quick flush back into the range, and there was no real how can I say, no real support or demand being found then. And that was the reason why I exited the trade. And then I said, but still, my hypothesis, longer term, is still valid. And I'm like, just like, I was like, you know what? Now, if we hold this level, so 830, 829, 830, I'm willing to re-enter. With a tight stop slightly below the intraday lows. And right now, if I look here at the chart, I think we took on momentum again, made new daily highs. So still a long way to go. I think we need to take out this blue trend line. But if we take it out, and if the Fed delivers next week or doesn't deliver anything at all, saying something like, hey, yes, we've seen there's some hawkishness being interpreted in our actions, and certainly we have to fight inflation somehow, we have to hike yields, and probably we will use some kind of a passive balance sheet runoff or so, but I'm sure we will be there if there's any kind of higher volatility. I think this is enough dovishness in the current environment where we have lots of this hawkish approach or expectation being priced in already, that this is then a clear bullish driver higher at first target, minimum 870. I could really imagine that in the months to come, especially in the first quarter, we have a serious chance to go back to 1,900 USD. This is, by the way, also one reason why I'm not that let's say bearish on US tech stocks right now. I mean, the picture doesn't look that promising anymore, but I think we are at least a little extent on the downside. I could imagine a bounce at least, and then we take it from there, wait for the Fed, and then, but I wouldn't short now any longer into the current weakness in equities. But coming back to gold, yeah. So this is my current take. So all in all, I think the picture is quite positive after holding this breakout region. And if we take out 870, I think then we're off the races on the upside.
Cool. All right. Thank you there, Jens. I'd say it's I would agree with you in the sense that I would say for about the last 6 weeks or so, gold was really just not doing a massive amount. Really, it was just going pretty much sideways in a small box. Although there was kind of maybe a bigger coil up happening. I like your trend line here, and invariably we're getting to a point where it's going to have to make a decision what it's going to do for the year. And you're absolutely right. I think the Fed might be the Fed might be either the juice that takes it higher, or the dampener that takes the wind out of its sails and stuff. So I will be watching this to see how it basically operates around here over the next few days, and then based upon that Fed, as I said, if it goes, I think it will go, and I think it'll be back up above 1900 and stuff, and that will give us that provides all sorts of other opportunities as well. Anything to add, Marcus?
In this case, I totally agree with Jens that gold is literally a long trend, and as you draw in the chart here with this higher highs and higher lows, it's a clearly trend. Even in this is daily chart, yes, this daily chart. And we saw the double low in March 2021, then the big move to the upper side, and also a triple low in August 2021. And since then, the market is rallying, kind of trending up. So it was in the correction, round about 1,745. And yes, the breakout this week was really, really interesting. Jens mentioned this on Wednesday, and at this moment in For All chart, we had two different trends. We had a short trend, but also a downtrend, an uptrend. And this case, the uptrend was a bit stronger because more buyers. The reason why, I don't care about why, because I don't know why.
Marcus.
Yeah, of course. But now I know why, because Jens was buying. So now I know why this breakout happens. So if I could
don't tell my kids.
Don't tell my kids.
Yeah, I know you want to buy a house for your wife. Yeah, the shoes, I know. So I hope you can buy now the house by this.
It depends on whether we break higher or not. So
yeah. So now I'm quite sure, but today's a little bit weaker, I guess, but this is what I need, that the price come a little bit back, that we see a little bit cheaper prices to come out of the correction. But basically, I totally agree that we should see gold a little bit higher. I'm not quite sure if we see the all-time highs around about $2,000, a little bit higher. I'm not so sure, but I guess I'm with Jens that 1,900 could be possible.
Cool, great. Thank you for that, chaps. So leading on from gold, I think I put in myself. Next chart was silver. Okay, just not a dissimilar story to what Jens had been talking. This is a weekly chart rather than a daily chart. Just because, as I said, I like weekly charts, and what we have here, you can see this week's has been a very bullish week so far for silver. But as part of that bigger picture, what I'm looking at is that effectively, I see that we have a little bit of a double bottom there forming there around between that kind of 21, 22 area, and I'm looking to see, is that actually going to break higher? Okay, from that, and we've seen gold has broken up a little bit, and also I'm just looking at if silver will do the same. On a bigger picture, what I'm looking at here is, for me, all right, is that we had here at the start of 2021, we had the tap of $30 there. Okay, I shorted there. That was, some of you might remember, that was when we had the kind of January, February last year, where we had the meme stock run, okay, of GameStop and all that. And all the Wall Street bets people said, that silver was going to be their next thing that they were going to take to the moon. And I was ready to short at 30 when they got there. The price action was beautiful. If you look at it on an intraday basis, it just double topped up there and fell away. And, everyone was screaming and shouting it was going $50 and above. But actually, we ended the year around about $23. All right. So, but as I said, I think we put a double bottom in there. What concerns me, or what I need to see happen, is that the 50-period moving average has acted as resistance there for the last 6 months. So for me, for a longer term basis, it's got to get above that kind of 50-period moving average, $25 and hold above there to give me a case that there's a longer term trend. And then if you are looking much longer term, I mean, it really does have to show that it can get up above 30, which I don't think it's been up above 30 for many, many years and stuff. So, so it's, so that's what I'm looking at the moment. I'm, tactically, I would bullish, but those are the kind of the 50, 25 and 30 are the kind of the inflection points I'd be looking at for where I'd need to make a decision. Any thoughts on that, gentlemen?
I love silver. So I love silver even more than gold, to be honest. And I think that silver, all in all, is undervalued when compared to gold. And I think it has really plenty of room to go if we go above that level. I really thought last year, by the way, I was the other side of the trade. The one you shorted, that was me. So no, but I was looking at that. I think there was some hashtag silver squeeze or so, right?
Yeah.
It was on Twitter. It was really, really hot topic. And there was also lots of volatility around that time. And I was in a chat that was just for fun, in fact, but with a physical gold dealer here in Germany. So Marcus, you know them probably. It's Degussa.
Yeah.
And they are quite active there because their CEO is also a very a well-known Eurosceptic. And I was there was a debate and then making some fun about the German government not getting their hands on enough vaccine and not being really organized in that. And the interesting thing was that I mentioned this, and that they said from the Gussa, well, in case of silver, we have enough to deliver if there is the rising demand there. And so they were well prepared for this potential squeeze higher, which then never happened, in fact. But I by the way, in addition to that, I also agree on 25. So over the last week, before this break in gold happened, I was also asked whether it's probably more favorable to take a position in silver due to let's call it the higher leverage or more potential there, more potential on the upside once we run higher. And I said, well, I like the picture in gold a little better because I can calculate my risk a little better. And in addition to that, I really like to see a silver holding above minimum 24, if not 25. And it's very interesting that you say that, or bring this up here too. I think the 200 moving average on a daily time frame is also around 25. Yeah. So I think this is the first key level longer term. And I mean, well, if precious metals really take off and we get some backwind from the Fed, well, why not? I think rather sooner than later run up to 30 is certainly something to consider.
Cool. Marcus, anything to add there?
Yeah, silver is kind of tricky charts. Basically, on a fundamental basis, we should say silver is a limited resource worldwide. Yeah, it's not unlimited available silver. So in a long term, maybe our kids or something else, silver's price is going higher and higher. But if you look at this picture, there is a restriction, a level on the higher side, as you mentioned, $30, and on the lower side, 21 roundabout. And since April 2020, price remains in this area, and this between these two levels. So in this higher time frames, it's kind of tricky to trade. But if you use this higher time frame and you use it in lower time frames to trend the charts, like you mentioned, when you saw in January 2021 this top, double top, and you use it for maybe forward chart or hourly chart, then I know now who pays your second Ferrari, because all the other guys who were long. That's really cool. So, but and also the lower.
Don't tell the retail traders, Marcus.
Yeah, yes, all the retail traders. Yeah. You can see the private trader sentiment, you know. There we can see it. And at the price of 2021, there was a kind of reversal bar. It gets in September 2021, there was a reversal bar, actually, where you drew it in. So it was also a perfect entry signal for lower time frames to start a trend and go up to 2024. So in this time frame, it's a kind of tricky, but to use it to find perfect trends in the lower time frame, really cool. But basically, I think silver remains in this level between 21 and 30 for the next weeks, month, I guess.
Cool. Great. Thank you, Marcus. So having looked at gold and silver, maybe we can, I think maybe a slide in for you, Jens, is that, yeah, put in the latest variation of gold and stuff. So what do you like about Bitcoin? What's keeping you awake there?
Well, the problem is what I liked about Bitcoin. I sent the chart yesterday, if I'm not mistaken, and then overnight we broke below 40,000. So the picture has darkened a little, let's say. But I mean, right now, I think the picture significantly darkened with a break below 40,000. I could probably, I could imagine that we are probably headed even lower than here. So 30,000, probably 25. So if you carefully watch, you can see this in the, or you can see it in the chart, but I haven't drawn it. But there's kind of a head shoulder formation. So with the lower high, which was put in around, I think, let me just check here. I think it was 50, yeah, 52. So that was at the beginning of, or no, it was shortly after, around Christmas, in fact. And then we pushed lower from there, attacking 40 and now breaking below. And again, so probably we are headed lower here over the next months, depending a little on what the Fed delivers. So I think it's massively estimated what the Fed event next week already could mean for the upcoming months, because all in all, market participants really expect the Fed to be quite hawkish again. So with hiking rates and potentially not just reducing their asset purchases, but bringing them back to zero and start to at least passively run off their balance sheet. This is an environment which, especially such high beta assets like Bitcoin or cryptos in general, I think don't really like. Even though I have to admit that longer term, I continue to be really bullish on cryptos in general. So yesterday, for example, a news came across my wire that Facebook, so or at least Meta, so no, it's not Facebook anymore, but Meta, that they and Instagram, so I think this is the same company, or at least they acquired Insta, if I'm not mistaken. Having something like 70% of all worldwide social media users, if the numbers are correct, 5 billion social media users around the globe, so 3.5 billion people. And let me just open here at my chart. It's Meta is working on plans to allow users to create and sell non-fungible tokens, so-called these NFTs, as Facebook's parent company seeks to join the rush of companies trying to capitalize on the digital collectible craze. And given that, even though if at first glance these NFTs look like, well, I mean, these are pixels and you sell them for hundreds of thousands of USD or whatever, or Ethereum, and then you calculate it in USD. It just, at first glance, it doesn't really make sense. But I think what people underestimate, that this whole meta play right now, this metaverse story, is here to stay, or the next big deal. Let's put it that way. I think the first sign was sent also at the beginning of this week with Microsoft then acquiring Activision Blizzard, for example. I think it's a 100% metaverse play. And that being said, I think digital currencies, and especially cryptocurrencies in the longer run, so this is probably not just a play for 2022, but probably a play for the next 5 years. I think that crypto is really here to stay. And I have to admit, by the way, that Bitcoin isn't really my first choice in this context, but especially Ethereum. I mean, also heavily beaten down, but I think this makes complete sense to really expect rather sooner or later to see another significantly run up higher, and not just driven by potential, how can we say that, people disagreeing with the Fed or not trusting the Fed anymore, or the US dollar continuing to be pushed lower for whatever reason. But I think also from a next generation play. So I think crypto, I think Katie Wood from Arc Innovation usually calls this disruptive disruptive technologies or so. So I think crypto is exactly filling in this gap to some extent, and that's why I'm all in all quite positive on crypto, because well, we are all getting older. So myself, for example, I'm not gaming anymore or something like that, but I can fully understand why people are now crazy about this acquisition from Activision Blizzard, Call of Duty, and what's the other thing? I think World of Warcraft, or Roblox, for example. I never played this, but my nephew, for example, is playing this Roblox stuff all day long, in fact. And that being said, and I think this metaverse play is quite big, and thus could see a massive spillover, given its hugeness or so, for the crypto space in general, and especially for cryptos like Ethereum.
Okay. All right, thank you. Thanks for that, Jens. I'd be looking at as just as the chart as we see there. Yep, it has been it topped out in November, so racing down. Okay, as you said, 40 was acting as a bit of a level of support, which we dipped beneath. Okay, yesterday. Then you're looking at if it continues that, then you're down to 30, and I think that's a reflection that it's a little bit of a punter's market, as in it just basically seems to be working at 30,000, 40,000, 50,000, 60,000, because there are lots of people who bought in late who are not really traders. They just come to the party late and are just basically looking at how it pivots around those big numbers and stuff. So I think my view would be, certainly for the next few weeks, is that a downtrend still on Bitcoin, and in fact most of those cryptos as a trade view for the next few weeks. Anything to add, Marcus?
Yeah, regarding cryptos, I have mixed feelings. So on the first side, there's the fundamental thoughts I have from a kind of logical side. So I would say, I cannot imagine that governments around the world will accept a currency which came from the darknet, still from the darknet, and is created by private persons around the world under such high electricity, energy, wasting of energy, like something like this, and it's highly unregulated. I cannot imagine. Maybe we have Salvador, which has this Bitcoin currency as an official currency, and they have big problems with the falling price in currency right now, in Bitcoin right now. So, and I cannot imagine. China has forbidden it. We have a couple of countries around the world, they have forbidden to mine currencies about wasting of this high energy level. So, and the other side, just my private opinion, I have really problems to imagine that governments around the world accept this unregulated private, by the way, really private currency to have an official payment possibility. This is just a fundamental private opinion. On the other side, from a trader side, I'm short since yesterday in Forex Chart because we had a lovely trend. And yesterday came the breakthrough to the lower side, and still a young downtrend in 4-hourly chart. And I think we go down to $10,000.
10,000. Good call, Marcus. Nice touch. Well done. Excellent. Because we've got a few slides to go. Let's but thank you for that, fellas. So here's my next slide, which was really just a look at US indices. We talked about sort of kind of interest rates, and I agree with Jens's earlier comment that probably the shorting has been done really well over the last couple of weeks, but I suspect it might sort of have a little bit of a breather before the Fed meeting next week. But the reason I put these up is because, here we go. Let me just move these out of the way here so you can see. Is what I've got here is Dow Jones on the weekly, S&P 500 on the weekly, NASDAQ on the weekly, and also DAX on the weekly. And more interestingly, what we're realizing is that you can see there actually over, since the start of the year, it's kind of been pretty much, and for those American indices and the Russell even more, is actually it's just been a lovely downtrend. And now what I see on a short term is that, we are at that kind of weekly 50, and around there on the Dow and the NASDAQ, and we're just, heading towards it on the S&P. So, my personal view is that actually I would probably be tactically short on those markets, but I would be wary of adding to my positions over the next couple of days in front of the Fed, because you have to hear what they have to say. I think that, my view would be to be tactically short, but we should never underestimate the inability for the Fed to step in and pump these markets even further in some way of form or another. So, if we see a heightening, as Jens mentioned earlier, we start getting interest rates, the people are baking in at least for this year. Also, if there's the issues with the tapers and the balance sheets, I think that will have a negative impact for stocks. And my view would be, if we get beneath those weekly 50s and start holding beneath it, well, then we start to drift lower. And as I said, I'd be looking to be tactically short, but I want to see how these markets respond to these weekly 50-period moving averages. Any points on those, boys, that you'd like to add?
Yeah. In this higher time frame, like weekly chart, you can see very, very clear that the uptrend is really, really, damn it old, I would say. So, and you can see in the press and in the news that most of the shares are really overestimated, all of them. So, and it's just a question of time that the market will come down. But in my opinion, this is a kind of experience of the last 23 years. The markets only will react when nobody is calculated in. So everybody's waiting for the big crash.
Yep.
And it will not come. So when all people say now no crash will come and everybody is buying, then the crash will come. So, yeah. And I don't know when, and I don't know what will be the high effect. So we saw the best example in February 2020, so before Corona. So we had all-time highs at that point. And I used to say to my clients, be careful, maybe there comes something else which will have the big effect. So no one thought about a pandemic at this time, but suddenly it was there. And then we saw the big crash. And actually, maybe the Russian-Ukraine crisis could be the effect, but maybe not, because as Jens mentioned a couple of minutes before, this is a crisis we have since years. Yeah, it's not a new thing. So, but maybe, I guess we are tired of this kind of Corona news. So, and the news, I think they will find a new, how should we say, a new kind of news to entertain the market. Yeah. And now this is the big game for Mr. Putin and the old man Biden. And oh my gosh, I can tell, I should say something. All those guys are old people. Yeah. So 10 years ago.
I think Vladimir Putin would disagree.
Of course, Mr. Biden too. Yeah. But by the
Mr.
way,
Biden doesn't understand the question, but Mr. Putin
this is absolutely highly possible. Yeah, absolutely. But I think, come on, from now on, 10 years in the future, no one cares about this guys. So, and the guys, the young generation is
Putin
tired.
Still disagrees, Marcus.
Yeah, maybe Paul too. But I guess the young generation, our kids, if you have some, they are tired of these stupid things of wars and crisis and something like this. So it's a question of time. But maybe actually in 2022, we could play this card to bring the markets a little bit down. But if it will the effect, if it will have the effect to make the crash, I doubt on it. I guess we see a kind of correction, and then we have a maybe a new uptrend. And yeah, this is what I can see actually in the charts. But in daily chart and in kind of 4-day chart, we have clearly downtrends, but they are still old already. Yeah, we had all-time highs already. So I think it's just a little bit to bring the weak hands, to kick the weak hands out of the market. Yeah, and then the institutional money is buying, because everything is a game of buying and selling. That's all.
Totally.
The interesting thing is, by the way, to just put things in perspective, because everyone is talking about yields, and I remember when we hit 1.8% on 10-year US Treasury yields, it was like, wow, now it's getting really expensive. The interesting thing is, if you take a step back, you see that last time, or the last times over the last decade, we saw 1.8% in US Treasury yields. I think it was in May 2012, it was in January 2015, November 2016 was around the election of Trump, August 2019, and then right now. So this has been the case over and over again. And I think I completely agree with Marcus here. So this is right now the topic, what the market is playing, but I don't really think that it makes sense from an overall fundamental perspective. Probably we are playing this now, and the psychology of the people kicks in, and they say, well, probably we've gone up too far too quickly and need to see a healthy corrective move or something like that. But I think, especially when it comes to tech, for example, I'm not really sure if yields really that matter, at least not now, and especially not for those companies which I consider, let's say, the tech names which are standing in the first row, not those in the second or third row, like those who have gone, let's say, berserk on the upside around the pandemic and after it, with Zoom and Peloton and so on and so forth. But those who are standing in the front line, let's say like a Tesla, Nvidia, Microsoft, Meta, or Facebook in this context, I think Google, I think they're all well positioned to weather any storm, probably really looking for such a sharper pull in, because then they can really go and say, hey, I buy this company because it's cheap now, and this one because we are sitting on a load of cash here and don't really know what to do with this. So let's buy these companies, like Microsoft now potentially did with ATV, so Activision Blizzard.
And that kind of, because I appreciate time is a little bit pressing for us, but that kind of brings us on nicely to your next choice, which was Tesla, their yens and stuff. What do you like about Tesla?
To be honest, right now, everything. So I mean, in 2020 or so, when we really went vertical on the upside, I was like shaking my head in disbelief and just thinking, hey, this doesn't make sense that we're selling these certificates and making money on them. And this then resulted in Tesla being included in the S&P 500, and the money, the company itself didn't make any money. And not selling cars. I mean, this is still a car company, let's say. But then I realized over time, and after studying a little through everything they offer, that it's not just a car company, but it's like like a tech company, and one with a very great growth outlook, to be honest, or at least in my personal opinion. I think they have plenty of fields they have an enormous edge in compared to their competitors. And given all that, and looking here at the battery innovation, looking at the productivity or production, where the cars are manufactured, so the manufacturing innovation, let's call it. So, and then also in addition here, the software innovation. If you put all this together and look at the current developments in the electric vehicle sector itself, and also look at the recent numbers they delivered already at the beginning of this month, here with delivery numbers topping 309,000 or so, bringing now analysts to expect that they probably will produce 2 million and more cars in 2022. And I have the feeling not any of the Wall Street analysts really expecting Tesla to deliver these numbers. I could really imagine the company to be underpriced. And right now, so we have seen a strong push higher. You can see it here. So the retest of this trend line and also of the breakout region around 900. That was, I think, in the first half or at the end of second half, something like that, early second half of December. And then we really took on momentum there. Then you see the gap higher there. That was the delivery numbers, and then we rolled over. But it wasn't because market participants started to become skeptical about Tesla, but it was more like the overall environment and a macro pressure, let's say, and the tech stocks being under pressure. But if you compare here the Tesla chart to the charts of other companies in this space, respectively in the tech space in general, then you will see that this is at least personally, I think that this is relative strength. And next week we have on the 26th of January, we have earnings after hours. And I really expect, to be honest, to see crushing numbers. And depending a little on how things play out now, but if the picture plays out as you described, with the markets stabilizing a little into the Fed, and probably the Fed then delivering more dovishness as expected and crushing earnings, I could really imagine that this is good for probably into the end of Q1, but probably at the end of Q2. It's good for a push up to and above new all-time highs. And I think this is valid as long as we trade above 900. I would reevaluate my picture on Tesla if we break below 900. But right now, I think that's very promising, to be honest, in the in the stock world, let's say.
Yeah, I'd be looking at that, drift down to that blue trend line in time for the earnings, see if the earnings are great, that'll provide a bounce, and off it goes. That would be my quick look on that. Anything you'd add on that chart itself, Marcus?
Yeah, it's I see Tesla a little bit difficult because Elon Musk is a special guy. And he loves to jump from one project to the others. So, and it's not a surprise that maybe one day he will decide to not run anymore Tesla by himself. So, and then maybe I'm not sure if will Tesla survive this on the long run.
You mean as Steve Jobs and Apple?
Yeah, for example, latest at this point. Yeah, but Elon Musk, he created a PayPal and then Tesla, and he has so many interesting ideas.
SpaceX, you shouldn't forget SpaceX.
SpaceX, exactly like this. So I'm not sure if he will run Tesla forever. Not forever, but not for, I don't know. So I'm a little bit, mixed in this point. But the share, basically, it's still long. It's a clear long trend. We kind of, circling correction right now. And you see this is a kind of, what do you see? It's still a trend. So I think it's still long.
Cool. All right. Thank you for that. I think I've got a couple of minutes, right? Just to, I think I put my last chart in here, just to finish us off with is, this is Deutsche Bank on the monthly chart here. All right. Deutsche Bank. Now, those people who know me would know that I have rarely have anything terribly good to say about Deutsche Bank and stuff. Whenever you see big trades going wrong, they're normally on the wrong side of it, but which has been reflected, it might be said, in this monthly chart of their share price, and it goes even, they were even higher, and it's just collapsed over the probably about the last 10 years or so. But there's always a darkness before the dawn, as they say, and I wonder now that actually having kind of rallied into sort of collapsed into those lows, the sort of kind of the COVID crash kind of into 2020 was almost like the last flush out. And in fact, what we've started to do is we've started to inch our way up, and it's just clear this way. And that actually, it looks like we could be building a bit of a kind of cup and handle formation there. Okay, so and I think if there are, if as we see, money shifts out of tech and into the energy and the financial sector, maybe Deutsche Bank picks up some of the play from that. What would you say to that, guys?
So I have my account with Deutsche, so I won't disagree.
Who cares, Deutsche Bank? Who cares anymore? No one cares about Deutsche Bank.
I have to admit, I'm really skeptical when it comes to the euro. We could easily do another 1 hour session now and talking about the euro, and I have nothing positive to say about the euro at all. The thing is, I really think that the euro is on the brink of collapse or brink of disaster, let's say, due to the banking sector. And so this is the funny thing now. So probably this inching higher is mainly driven by yields. I think German Bund yields just hit 0% again. So picking up due to inflation and so on and so forth. Let this chart speak for itself. Let's put it that way. So
exactly.
Yeah.
How about yourself, Marcus? 60 seconds on Deutsche Bank. What do you make of it?
It's who cares, Deutsche Bank? Who cares?
That's it. That's all we need to hear from what you say.
3 seconds.
No, I would agree with you in the sense of, my sentiment about the organization, might differ greatly. It's more a case of, as a trader, I look at what I see there, trade what I see, and I see that as perhaps a cup and handle formation starting to form after what has been almost like a decade-long downtrend and such. But
do you want to hear a funny anecdote into the end of the webinar?
Well, of course, there's always a funny anecdote about Deutsche Bank. We've all got them.
When I was in my early 20s, I really wanted to work for Deutsche Bank and wanted to become a trader at Deutsche. And I was still a trainee back then in a bank, by the way, which was then acquired by Deutsche shortly after I left the bank. And I was so excited and so motivated to get a job at Deutsche and at their trading desk that I went out and bought a tie in blue, black, and white. So especially blue, here the colors of Deutsche. And I wanted to wear the tie for my invitation to an internship/interview. I never used the tie at all, to be honest. But that's my funny anecdote about Deutsche.
We all did foolish things when we were young. Yes, you can get away with it.
And stuff. That was more than all the others.
That was in 2005 or 2006, so that was shortly before the big crash. So
there you go.
Maybe you got the reason for the big crash.
Yeah. Well, I would have turned things around for them, but yeah.
That tie was the straw that broke the camel's back. That's it.
I guess the tie was the reason.
So to very quick, because I appreciate on the press and the time, fellas and stuff, is that thank you very much for that, guys. But just for those of you watching it, yeah, 2021 was a bit of a wild ride. 2022 has been a volatile start. I still think that kind of we need some completion on that kind of Ukraine tension. And then based upon how the US and the Europeans respond to that or don't, I would still be tactically short on US indices, but ready for support to step in. We didn't really even get time to go into stuff like the dollar, how I'm still bullish on energy and financials. And I'm actually still bullish on UK FTSE, which of all the indices which have rolled over, invariably it has managed to just keep chipping north in terms of its 2022. As always, what I say to everybody is, you can do all the analysis you want, you do all the trades you want, but if you ain't managing risk, you're going to be roadkill. So invariably, you always manage risk first and foremost, and that's what we've always banged on about. Okay, if you have particular questions about today's session, you can get in touch with us. Global at admiralmarkets.com there. Okay, this video will be on the Facebook and the YouTube channel as well. And so actually it just kind of sort of remains for me to say thank you to all for you joining us, and to thank you to my guests Marcus and Jens there. We flew through that in a quick way, but invariably, as I said, there would always be plenty for us to talk about. We were never going to be short of topics for discussion. So thank you, Marcus. Thank you, Jens, for joining us. That was a great view. Thank you very much. And as always, it remains for me to say thank you for joining us, ladies and gentlemen. If you've watched this on YouTube and liked it, make sure you subscribe, give us a thumbs up. And as always, I wish you the very best of success in your own trading endeavors. And undoubtedly, we will speak to you soon. Many thanks, people. Take care.
See you. Bye-bye.
See ya.